Right. So last week we covered fixed income securities. No, that was the week before. And last week we did business valuation based on three models, right? Right, absolute valuation methods and relative valuation methods. Under absolute valuation, we did cash flow discounting, right, dividend discounting models, and then we analyzed the balance sheet. Under relative valuation, we compared the ratios against peers, right? And then we did IFRS 9. So let's continue today in a new area. On risk, right? So how would you define risk now before we get started? Sorry, by the way, there is an announcement from the institute. There is apparently an evaluation form which you all need to fill, right? You don't have to do it now itself. So when time permits, just download it from your classroom and fill it up and send it to the institute, right? You don't have to do it now. Right, so do your evaluation forms when time permits. So until then, right, how would you define risk? What does risk mean to you? Well, actually, from grade 2 onwards, we've been hearing this word risk, and we've been analyzing risk. Right, every day we deal with risk. So, how would you define risk? Uncertainty. Good. What else?
Probability of loss.
Probability of loss. Very good. Anything else? Any other definitions? What does risk mean to you? Is it good or bad?
Either
Pardon?
both good and bad. In case of a bad, uh, in case of a risk, there's a possibility of opportunities.
Okay, right. So bad because
Which might impact on our smooth operation of activity.
yeah, like Prasanna said, there is a probability of loss also, isn't it? Right? Yeah. So now, can you give me one example of something which has zero risk, no risk at all? Anything which carries zero risk.
Government securities.
Government securities, okay. So government securities carry zero default risk. But do they carry any other risk?
Interest rate risk for government securities.
Yes. Government securities carry interest rate risk, right? But there is no default risk, as you rightly said. So is it correct to say that government securities carry zero risk? Hello? Yeah, it's not 100% correct that government securities carry zero default, zero risk, because they carry interest rate risk, although they don't have default risk, right? So can you give me another instrument which has zero risk, no risk at all? Government securities carry zero risk. They carry interest rate risk. Another instrument which carries zero risk. Any other examples? Foreign currency ones carry sovereign risk. Yes, government securities, if they are denominated in foreign currencies, they do carry sovereign risk, right? Now, that is because although the government can print rupees, so therefore they don't have default risk, they can't print dollars, right? They can't print dollars. So they foreign currency denominated government securities, yes, do carry default risk. Cash against loans against cash balances, FDs. Okay. Um, right. Well, it carries when the loan matures. If the customer settles early and he runs the deposit when interest rates fall, right? Let's say there's a deposit going at 10% and the customer borrows at 13%, but somewhere in between he settles his loan, right? Because interest rates have fallen to 5%. Then you run the deposit at 10%, but the loan is settled. And he takes a fresh loan now at 8% without any security. Can it happen? Yes, it can. Right, so you have reinvestment risk. Well, the point I'm trying to make is there is no instrument which carries zero risk, right? Nothing. Even the wife is a risk. Okay. Everything is risky. There is nothing which carries zero risk. Now, take your this course for example, right? If let's say you're doing banking DABF, right? So when you study for an exam and you sit for an exam, there is a chance that you might fail, right or wrong? Right? Whenever you sit for an exam, there is always a chance that you might fail. But right, so the way to avoid the risk of failing is not doing the exam. Is it? If there is a risk of failing, what if I say the solution is not taking the exam? No, because if you don't take the exam, you won't fail. No? So what's wrong with that solution? Not taking the exam, then you're not taking a risk. If you don't take the risk, there is no risk of failing. What is wrong with that solution? Doesn't it make sense? Not taking a risk. Yeah, if you don't take the risk, there is no chance, absolutely no chance that you will pass either. Because if you either sit for the exam, there is 50-50 chance of you getting through. But if you don't take the exam, it's as good as failing, right? So the biggest risk you can take is not taking a risk. Do you all agree or disagree? Not taking the a risk is the biggest risk, which means you take a risk. If it works out, you will gain. But if it doesn't work out, you will lose. So, in my view, to me, risk means the downside, right? Because you take a chance and it works, you make a profit, right? You profit out of it. That is not the risk. The risk is the downside, right? And the downside comes because things are uncertain. Okay, so the downside of uncertainty is risk to me, right? So, what are the kinds of or the types of risk you all can think of? Types of risk. Yeah. Can you give me some types of risk?
Liquidity risk, interest rate risk,
Yeah. Good. What else?
Operational risk.
Yes, very good. Interest rate risk, liquidity risk, operational risk.
Market risk.
Market risk. Okay, very good. Examples of liquidity risk. Lehman Brothers, or during the subprime mortgage crisis, Lehman Brothers crashed. No? They crashed because they did not have liquidity. They were a global giant, but still they crashed. There's no liquidity. Examples of operational risk. Well, actually, if you take the Nick Leeson case, like Nick Leeson's case, it contains all of these risks. You get operational risk, right? The same guy was running the front office, middle office, and back office. Can you all remember Nick Leeson, by the way? Never heard of Nick Leeson? Yeah. Okay. Right. Well, at least you all remember. That's good. Yeah. So Nick Leeson, there was operational risk, liquidity risk, market risk. Okay. Remember, the market went against him, so that was market risk. Then liquidity risk is Barings Bank crashed because they did not have liquidity. What else? Is that all? What about legal risk? The risk of litigation, reputation risk. If your reputation, banking is based entirely on reputation. So if your reputation suffers, you might not be able to survive, right? Credit risk, something most of you are dealing with on a daily basis, isn't it? So there are so many types of risk. In fact, the list is almost endless, goes on and on and on. What about technology? Technology risk, the risk of hackers, viruses, right? So there are so many kinds of risk. Now, the other thing is measuring risk is also very important, right? So today we are going to discuss a method of measuring market risk. right? Market risk mainly. That's called value at risk. It was developed by JP Morgan. By the way, next week we may not have classes. Well, I'm still not 100% sure, but I will inform the institute sometime next week. Okay, so let's skip these slides. It's the history about JP Morgan, how it started. Value at risk, right? Any idea what value at risk means? Well, in summary, it means the maximum possible loss over a given period of time and a given confidence level, right? So that's very important. The given period of time and confidence level. So without a time period and confidence level, value at risk makes no sense. Okay. Now, if there's a question at the exam, just make sure that you have been given a time period as well as a confidence level. Without those, value at risk doesn't make any sense. Value at risk is an attempt to provide a single number summarizing the total risk in a portfolio of financial assets, right? A single number summarizing the total market risk in a portfolio of financial assets, right? So just make a note, it's market risk. It has become widely used by corporate treasurers and fund managers as well as by financial institutions. Value at risk states at some probability, often 1% or 5%, the expected loss during a specified time period. So that's very important. At some probability, the expected loss during a specified time period, right? So this probability of 1% or 5% is actually called the significance level, right? So you either need a significance level or a confidence level, which is 1 minus a significance level, right? So if the significance level is 1%, that means the confidence level is 99%. Or when the level of significance is 5%, it means the level of confidence is 95%. The expected loss during a specified period of time. And so it's very important that you have either the significance level or confidence level and the time period. The variable V is the value at risk of the portfolio. It is a function of two parameters, the time horizon and the confidence level. And so remember, for value at risk to make any sense, you need the time as well as the confidence level. All right, so let's see what this means. Let's go through this example. A $100 million portfolio has a 1.37% value at risk at the probability at the 5% probability over 1 week. Calculate what could be lost and explain what the loss means. Right. Now let's just jump a couple of slides onto this one. Right. Have you all seen this kind of curve? What is it called? A bell-shaped curve is called a bell-shaped curve or a normal distribution curve. Right, something we have already learned in grade 2. Now, when you have a normal distribution curve, it has, well, actually what you get under the curve is the probability, right? So if you add up all of these points, you get a probability of 100%, right? And the center line splits it in half. So on the left, you get 50%, and on the right, you get another probability of 50%. And the center line is where you get the average, right? And from the center up to the end is called the distribution, right here, the distribution of the potential asset values, right? So what is on top is above the average, and what is below the center line is called below average, right? And now normally when you plot distributions above average and below average, your losses will come when it's below average, right? So below 50% is below average, and the losses will be towards the left side, right? Extreme loss. It's called the tail risk, what you get here on the left side. The shape of the distribution is determined by the volatility of the asset, right? So if the asset is more volatile, you might have even further distributions. The tail might extend further, something like this, then the height will be a little less. But if the volatility is much less, then you will have a taller curve where the tail is much shorter. Okay, so if let's say for example your average profit is 100 million rupees, the center line will give you the average profit 100 million rupees. Then as you go to the right, your profit level will increase. You go to 101, 102, likewise 150, maybe 200, and it will keep increasing. So towards the right, you have your profits. Whereas when you go towards the left, right, the profitability will reduce 99, 98, 97, maybe 50, 20, 50, 25, 20, and here might be 0. So anything below 0 will be losses. And as you go further to your left, the loss will only increase, right? 100 million portfolio has a 1.37 value at risk at the 5% probability over 1 week. Calculate what could be lost and explain what the loss means. So it says 1.37 value at risk, right? So out of the portfolio of 100 million, 1.37 is at risk. That means 1.37% of the 100 million, which is 1.37 million. At the 5% probability over 1 week. Right? So this 5% probability is called the significance level, the level of significance. And the time period is given as 1 week. That means you're 95% confident that over the next 1 week, you will lose a maximum of $1.37 million, right? Which means there's a 5% probability. Remember, you're only 95% confidence. And this 5% probability means there is a 5% probability that your losses will be more than $1.37 million over the next 1 week, right? So 95% of the time, your losses will be less than $1.37 million. But there is a probability of 5% that it will exceed $1.37 million. So calculate what could be lost and what the loss means, right? So over 1 week, the portfolio could lose 1.37 million of 100 million, which is $1.37 million. And there is a 5% chance that more than this will be lost and 95% chance that less than this will be lost. And so let's go back to this curve. Now, if you go through this curve once again, you will see that you take the center line, below that is 50% of the probabilities. 50% of all outcomes are towards left and 50% of all outcomes are towards the right. And the losses on the left side. Now, if this black line indicates the 5% level of loss, right? What it means is to the left of this line, you have 5% of all outcomes, right? So 5% is here, which means since the entire curve is 95%, to the right of this line, you get, sorry, the entire curve is 100%. So here, if you have 5%, what is remaining is 95%. Right? What remains is 95%. Then if you want to get to 99%, the black line should move to the left or to the right. So this 5% is the level of significance. It's the level
To
of
the left.
yeah, if you want to get 1% significance or 99% confidence, then this black line should move to the left, right? So that the area to the left will reduce. From 5%, it will drop to 1%. Now, when that reduces, what remains is 99%, because you leave out 1% here to the left, 99% is remaining, right? Which means if you increase your level of significance or increase the probability as you go further to the left, the amount of loss will reduce or increase. If you understand that concept, then value at risk is very easy. That is the crucial thing to understand. As you go to the left, right, your level of significance reduces, meaning the level of confidence increases. So when your level of significance reduce and when the level of confidence increase, will the value at risk reduce or will it increase? Yeah.
Decrease?
It will increase, right? Because as you go to the left, when you go towards the left, the amount of loss will increase or reduce?
Reduce.
No, the losses will increase. No? See, this is your average profit, right? So your losses are always to the left now. And when you go further to the left, right, further to the left, losses will increase or reduce? Remember what I said earlier? Now just assume this center line is the 100 million profit mark, right?
It will increase.
Yeah, your losses will increase. As you go to the left, losses will increase, right? So this might be your break-even point. You make zero profits, zero losses. And to the right, you make lots of profits. But when you go further to the left from the break-even point, your losses will increase, isn't it? Right or wrong?
Right.
Yeah. Right. So if this is the 5% level of significance or the 5% probability level, right? Remember, this is the 50% probability level, and here could be the 75% probability level. So at the 5% probability level, let's just assume you're losing 1.37%. And at the 1% probability level, that means you will lose more, isn't it? Here the loss is worse now. And because if you go towards your right, your losses keep reducing. And the moment you pass the center line, then your losses keep increasing. Okay. So, sorry, when you pass the center line, the losses keep reducing and it reduces, you go beyond 100 million profits, right? I'm just taking example, I'm throwing out numbers, but the idea is as you go to the left, your losses will increase, and as you go to the right, the losses will reduce. Understood? So at 5% probability, if you're making a 1.37% loss, at a 1% probability or 1% significance, in other words, right? Your losses will, at 1% significance, your losses will increase. Yes. That's a significance level plus confidence level equals 100%, which means your significance level is equal to 100% minus confidence level. So if your significance level is 5%, what would be the confidence level? In other words, confidence level equals 100% minus significance. Right, so if significance level is 5%, what would be confidence level? 95%. Yes. So if significance level is 1%, then confidence level would be significance level is 1%, confidence level would be 99%. Yeah, good. Right. So if you get an MCQ question, right, which says $100 million portfolio has 1.37 value at risk at the 5% probability over 1 week, what would be the value at risk at a 1% probability over 1 week, right? Understood? So the same question, the extension is what would be the probability and the value at risk at 1% probability over 1 week, right? First answer is more than 1.37%. Second answer is less than 1.37%. Third answer is it can either be more or less than 1.37%. Fourth answer is unable to determine. What would be your answer? Will it be more than 1.37 or less than 1.37? Yeah. At 1% probability, will the value at risk be more than 1.37% or less than 1.37%?
Sir, I didn't get the question.
Yeah, the same question, right? 100 million portfolio has a 1.37% value at risk at 5% probability over 1 week, right? So if the question says value at risk at 1% probability over 1 week would be part A is more than 1.37%, part B less than 1.37%, part C more or less than 1.37%, part D is unable to determine. What would be your answer? Same thing that we were discussing. If you all remember that principle, then it's fine. Okay. So at 5% probability, what is value at risk? Hello. remember this graph? As you keep reducing the probability, what happens to the loss? Will it increase or reduce?
Increase.
It will increase. Yeah. So at 1% probability, the value at risk will be more than 1.37%. Right. So remember, when you increase the probability, the value at risk will reduce, and when you reduce the probability, the value at risk will increase. Right. So there is an inverse relationship between the two. That's the easiest way to remember it. This question says 100 million portfolio has 1.37% value at risk at 5% probability over 1 week. That means there is a 5% chance that you will lose more than 1.37% and 95% chance that you will lose less than $1.37 million, right? So 95% of the time your losses will be less than 1.37 and 5% of the time it will be more than 1.37%. So the next 1 week, there is a 95% probability that your maximum loss will be $1.37 million. Then issues with value at risk. Value at risk time period should relate to the nature of the situation. A traditional stock and bond portfolio would likely focus on longer monthly or quarterly value at risk, while a highly leveraged derivatives portfolio might focus on shorter daily value at risk, right? So it has to correspond with the level of risk you're taking. If you are taking risky positions, your value at risk will be higher. Sorry, the time period you should consider will be lower, right? Risky the portfolio, you have to take more frequent value at risk, because leverage means you're taking more risk. When you're taking more risk, you have to take a shorter time period. The percentage selected will affect value at risk. The 1% value at risk would be expected to show greater than a 5% value at risk, right? So that's what we discussed earlier. Remember, at 5% it's 1.37, meaning at 1% it will be higher. The left tail should be examined. Okay. Always examine the left tail. Left tail refers to the traditional probability distribution of returns. The left side displays the low or negative returns, which is what value at risk measures at some probability. Okay, so always the losses will be on the left. Because you are looking at the risk, you have to always observe the left side. Now, there are three ways of calculating value at risk. The first one is called analytical value at risk. The analytical method or variance covariance method is based on the normal distribution and the concept of one-tailed confidence level, right? That means the left tail only. So value at risk is the mean return minus R sigma Z into the value of the portfolio. Shall we try this example? Now, this Z term, the Z scores that you have done at obtained for A levels. Nobody understood now. What it means is it is the X minus mu into sigma, right? That is the Z score. That is how you measure Z score. It is the value minus the average divided by standard deviation, right? Now, I'm not going to great detail because all you need to know is only how to calculate. So far, there have been no questions on EZ scores or on value at risk. Right? And these EZ scores at various levels you need to remember. At 95% confidence or 5% significance, EZ score is 1.65. Then at 99% confidence or 5% significance, score is 2.33. These values you need to remember, right? So if it's given at the exam, you should remember that 95% confidence Z is 1.65 and 99 Z score is 2.33, right? So those values you must remember. 5% value at risk, 1.65 standard deviations below the mean. And at 1% value at risk, it's 2.33 standard deviations below the mean.
Here, 99% confidence, 5% significance, or 1% significance.
99% confidence is 1% significance, right? Remember this equation? Significance plus confidence is 100%. So 1% significance is 99% confidence. The two should add up to 100%. Okay? This one.
In your calculation, it is 5%.
This one? Ah, okay. Oh, sorry. Yeah, thank you. I was just checking whether you all were observing. Thank you. That was a good catch. Value at risk for periods less than 1 year are computed with the return and standard deviations expressed for the desired period of time. For monthly VAR, divide the annual return by 12 and standard deviation by the square root of 12. Then compute monthly VAR. For weekly VAR, divide by 52 and standard deviation by square root of 52. Likewise, right? If the period is very short, you can ignore Z. Right, so let's try this example. The expected annual return is 100 million. Now for 100 million portfolio, 6%, right? Expected annual return for 100 million portfolio, 6%. Historical standard deviation or sigma is 12%. You asked to calculate value at risk at 5% significance. So at 5% significance, straight away you should know that the Z score is 1.65, right? So let's try this. Analytical value at risk. return is 6%. Standard deviation 12%.
Sir, can you please increase the font size?
Oh yes, sorry. And the Z score and 5% significance is 1.65. Okay, this will be your value at risk. What is the time horizon? Time horizon is annual. What would be semi-annual value at risk? How do you calculate? See if you all could remember, for monthly value at risk in the previous slide, divide the annual return by 12. So, and returns have to be divided by the number of compounding periods and standard deviation by square root of 12. So the number of compounding periods for a year is 12. So you need to divide the return by 12 and standard deviation by square root of 12, right? So the same thing. If it's semi-annual, you need to divide by 2, the return by 2, standard deviation divided by the square root of 2. Let's calculate quarterly. Return divided by compounding period 4. Then let's take monthly weekly. And finally, daily. These are the figures that you end up with. Now you will notice that as the time period keeps reducing, right? As you keep reducing the time period, the value at risk drops. And as the time period increases, value at risk also increases. Any questions up to now?
Are all these minus balances?
Yeah. Well, it's like this now. In this case, it indicates that you're making losses, right? Otherwise, it will give you the worst possible outcome.
Okay, sir.
Right. Now, how do you interpret $13.8 million in this? The first answer, how would you interpret? $13.8 million. Loss of $13.8 million. Over the next 1 year period, right, there's 95% probability that over the next 1 year period, your maximum loss is going to be $13.8 million. In other words, there's a 5% probability that over the next 1 year period, your maximum loss is going to be more than $13.8 million. Okay, so that's how you need to interpret. The interpretation is that there is a 5% probability that the annual loss will exceed $13.8 million and a 95% probability that the annual loss will be less. Computing weekly value at risk for the previous example, to complete weekly value at risk, you need to divide by the return by 7, by 52, and standard deviation by square root of 52. So what happens when you increase the significance, sorry, when you reduce the significance level? No, before you do any calculation, what can you say? What happens to value at risk when you reduce the significance level?
Risk will increase.
Yes, the value at risk will increase. is when sigma is when is it it's 2.33. Is 1% significance.
Can you share the Excel?
Yeah. You all have been getting the previous Excels also, no? I've been sending.
Yes, but I'm talking about now.
Yeah, I'll send this. Okay, so is this clear? Only change you make is you increase the sigma level. The Z score, right? From 1.65 at 1%, it increases to 2.33. So this is 3.76% of 100 million. Advantages of analytical VAR method, very easy to calculate and easy to understand. Any donkey can understand and any donkey can explain. It gives a single number, right? Allows modeling the correlations of risk. So you can do it for various correlations. When you change your correlation, your standard deviation will change. Can be applied to shorter or longer time periods as relevant. A disadvantage is it assumes there is a normal distribution, right? Without this assumption, this doesn't work. Many assets exhibit leptokurtosis, which is called fat tails. When a distribution has fat tails, value at risk will tend to underestimate the loss and its associated probability, as extreme returns occur more frequently than assumed by the normal distribution. Right? So analytical value at risk assumes there are no fat tails, right? It assumes there are thin tails like this. Fat tails means you have more extreme losses. The tail is fat. The difficulty of estimating standard deviation is in very large portfolios. And if your portfolio size is very large, then it's very difficult to calculate standard deviation. Second method is called historical value at risk. The historical method for estimating value at risk is sometimes referred to as the historical simulation method. Right? The first one was analytical, now we get historical. One way to calculate 5% daily value at risk using the historical method is to accumulate a number of past daily returns. Right, this is how you do it. You get the past daily returns. Maybe you're analyzing the last 100 days returns. So you get the past 100 days returns, then rank the returns from the highest to the lowest, right? So you have to rank them from the best return to the worst return and identify the lowest 5% of returns. Then you need to identify what has given the lowest 5% of the returns. So if you are analyzing 100 days of returns, you take the 5 days of lowest returns. That's the lowest 5% of returns. The highest of these 5% of lowest of returns is the 1-day value at risk, right? So the 5% position will give you the 1-day value at risk. You have accumulated 100 daily returns from your 100 million portfolio. After ranking the returns from highest to lowest, you identify the lowest 5 returns. Right, so this must be, let's assume these are in percentages. Right, so you have been given the 5 lowest returns. First one is minus 0.0019%, then minus 0.0025, 0.0034, 0.0096, 0.0101. Right, so it has been ranked from the lowest negative return to the highest worst negative return. So it's 100 days. You asked to calculate daily 5% significance using the historical method. That's 100 days into 5% is the fifth worst day. Now, what is the worst day? What is the return on the worst day? Yeah.
It's 0.0101.
Yes, correct. 0.0101 is the worst return, right? Second worst return is 0.0096. Third worst return, 0.0034. Fourth worst return is 0.0025. And the fifth worst return, 0.0019. So 100 days, 5% is the fifth worst return, which is 0.0019. Right? So that is your 5% value at risk. Now, what if you were to find the 1% value at 1% significance value at risk? 1% significance value at risk. Yeah. 1% significance value at risk would be the worst return. So 100 into 1% is 1. Worst return is 0.0101. Right? Okay. Advantages of historical method, very easy to calculate and understand, very easy. It does not assume return distribution. So it doesn't have to be a normal distribution, can be any distribution. Can be applied to different time periods according to industry custom. Right? And the primary disadvantage of historical method is the assumption that the pattern of historical return will repeat in the future. So history might repeat in the future. That is the main disadvantage. You assume that history will repeat. That is, it is indicative of future returns. The Monte Carlo value at risk method. Monte Carlo. So this is a computer intensive system mechanism of calculating value at risk. Monte Carlo method uses computer software to generate hundreds or thousands of possible outcomes from the distributions of inputs specified by the user. The user might specify normal distribution for some assets, skewed for others, leptokurtosis for others, and complex shifting correlations over time. The runs of possible outcomes can be ranked from highest to lowest. Right? So again, you have to rank them like historical method. Okay, so I'm just going through these methods step by step. Observe them carefully. This is how you need to do it. But the good news is it's identical to historical method to determine the results at any given probability. So let's try this example. The Monte Carlo model has generated 100 runs of possible output over 1 week periods. The average return and standard deviation are 5.7 and 2.1% respectively. The 6 worst outcomes are 0.5, 1.5, 1.6, 0.3, 0.7, 0.5. The portfolio is known to include extensive option positions. You asked to calculate 1 week value at risk at 5% significance for a beginning portfolio value of 100 million. Okay, now, so there is an interesting statement. It says the portfolio is known to include extensive option positions, right? So that means there can be extreme outcomes. If you have options, your outcomes might be pretty extreme. So if that is the case, you can't use analytical value at risk, right? You have to use either historical or Monte Carlo. So you have 100 runs of possible output over a 1 week period. The average return and standard deviation are 5.7, 2.1. So you have been given the return and standard deviation just to mislead you, right? So that the first thing you will think of is analytical value at risk, right? Remember, if it includes option positions, you cannot use analytical VAR. You have to use Monte Carlo or historical. You asked to calculate 1 week value at risk. 1 week 5% at 1 week value at risk at 5% significance for the beginning portfolio value of 100 million. Right. So let's try this. Right. So 6 outcomes 0.5, 1.5, 1.6, 0.3, 0.7, 0.5. 5% significance out of 100 runs, you should find the fifth worst return, right? So is it 0.3%? Fifth worst return, 0.3%? Is it? Hmm? Is it 0.3%?
Yes.
No, it is not. Why? What is the first thing you should do? Should you not rank the returns? Either from best to the worst or worst to the best. So if you rank them, you have to rank, don't forget. If you rank them, what is the worst return? Out of a given set of returns, what is the worst return? Point 0.3. Right. So that is the worst. Second worst, 0.5, and you have 2.5. Third worst return, also 0.5. Fourth, 0.7. Fifth, 0.5. And sixth, 1.6. It says 1%, 1 week value at risk at 5% significance, which is the fifth worst outcome, right? Fifth worst outcome is 1.5% of 100 million is 1.5 million. Okay, any questions up to now? Okay, so that's Monte Carlo. The primary advantage of Monte Carlo is also its primary disadvantage because it incorporates many assumptions regarding return patterns, correlations, and other factors the analyst believes are relevant, right? So it may assume some random relationships between correlations. That leads to its downside. The output is only as good as input, right? Which means garbage in, garbage out. This complexity can lead to a false sense of overconfidence in the output amongst the less informed. It is data and compute intensive, which makes it costly to use in complex situations. Where it may only be the reasonable method to use. Right? So it requires a huge investment. Advantages of value at risk. It has become the industry standard for risk measurement and is required by many regulators. It says 1%, 1 week value at risk at 5% significance, which is the fifth worst outcome, right? Fifth worst outcome is 1.5% of 100 million is 1.5 million. Okay, any questions up to now? Okay, so that's Monte Carlo. The primary advantage of Monte Carlo is also its primary disadvantage because it incorporates many assumptions regarding return patterns, correlations, and other factors the analyst believes are relevant, right? So it may assume some random relationships between correlations. That leads to its downside. The output is only as good as input, right? Which means garbage in, garbage out. This complexity can lead to a false sense of overconfidence in the output amongst the less informed. It is data and compute intensive, which makes it costly to use in complex situations. It may only be the reasonable method to use. Right? So it requires a huge investment. Advantages of value at risk. It has become the industry standard for risk measurement and is required by many regulators. Hello?
හොඳයි. දැන් බිස්කට් කෑවා නේද? ඇයි?
Yeah, so it looks like someone is hungry. Interesting. Kaju and biscuits.
ඔයාගේ ගේම් එක ඉවරයිද?
Hello? Okay, right. So after biscuits and kaju, let's continue. That was a small commercial break. Good entertainment. Okay, so value at risk is the industry standard for risk measurement and is required by many regulators, right? So most of the regulators insist on value at risk as the measure. It aggregates all risk into one single, easy to understand number. So the entire gamut of market risk you can express in one number, right? It can be used in capital allocation. The limitations of value at risk, some methods are difficult and expensive to implement. The different computation methods can generate different estimates of value at risk. Okay, so if you use Monte Carlo, historical, and analytical, you might end up getting 3 different numbers of value at risk. So which one do you use? It can generate a false sense of security. It is only as good as inputs and estimation process. Even when done correctly, it is probabilistic. Things can always be worse, right? So you cannot afford to be overconfident. Just because you do Y, it doesn't mean you have everything covered. It is one-sided. It focuses on the left tail in the return distribution and ignores the upside potential. So these are the limitations of value at risk. You have no clue what you actually don't even consider what the upside is going to be like. Right. So stress testing. Stress testing is often employed as a complement to value at risk. It may reveal outcomes not reflected in the typical value at risk calculation. For example, the manager might use the historical standard deviation in estimating value at risk, and if nothing unusual occurred during the measurement period, the estimated value at risk will reflect only normal circumstances. Right? So if it eliminates unusual things like maybe a tsunami or stress testing is just an extreme scenario, right? So you can use stress testing to check what happened during a real crisis. Scenario analysis is used to measure the effect of the portfolio of simultaneous movements in one or several factors. In a scenario analysis, the user defines the events such as interest rate movements and changes in currency rates. Like, for example, in Brexit, markets became very volatile. And changes in volatilities, changes in asset liquidity, and so on. And compares the value of the portfolio before and after the specified events. Potential weaknesses in any scenario analysis include the inability to accurately measure byproducts of major factor movements. That is the impact a major movement in one factor has on other factors. includes the effects of simultaneous movements in risk factors. And so you can't be 100% accurate when you do scenario analysis. You don't know the cross relationship between factors. Forms of scenario analysis, right? There are three forms. Stylized scenarios, the analyst changes one or more risk factor to measure the effect on the portfolio rather than having the manager select the factors. Some stylized scenarios are more like industry standards. Okay, so you have been given certain models that will be your scenarios. Stylized scenarios help managers avoid oh no syndrome, as in oh no, why didn't we think of that? Actual extreme events. The analyst measures the impact of major past events, such as market crashes in 1987 and the 1990s technology bubble on the portfolio. And so you assume that a crisis that happened some time back is now happening again. So how would your organization react? Hypothetical events are extreme events that might occur but have not previously occurred. These tests are subject to same weakness as other scenario analysis because they are subject to incorrect assumptions and correlations. The stress testing models. Stress testing and stress testing models are just an extension of scenario analysis, focusing on adverse outcomes. Stressing can be done as factor push analysis, which is a simple stress test where the analyst pushes factors to the most disadvantageous combination of possible circumstances and measures the resulting impact on the portfolio. That's called factor push analysis. You stress certain factors like maybe an interest rate to the most disadvantageous combination, right? Maybe a 10% overnight interest rate hike, something like that. Maximum loss optimization. Now, even though you stress your interest rate to 10%, that might not result in the maximum loss, right? It might be a 5% interest rate hike combined with an exchange depreciation of another 5%. Maximum loss optimization uses more sophisticated mathematical and computer modeling to find the worst possible combination of factors. Worst case scenario is the worst case the analyst thinks is likely to occur. And so those three methods can be used as stress testing models. Okay, can we try these questions? First one, consider a portfolio that has the following characteristics: an expected return of 12%, $1 million portfolio value, annual standard deviation equal to 6%. What is the value at risk of the portfolio at 99% probability levels? Okay, so what will you use? Which model will you use out of the three scenarios? Analytical, historical, or Monte Carlo?
Analytical.
Analytical, yes, very good. So let's try analytical. Return is 12%. Portfolio value is $1 million. Standard deviation 6%. Then Z score at 99% probability is 2.33. Of 19,800. Right, so answer is B. Question 2. Gregory Chambers is interested in estimating the daily value at risk with 99% probability of the bank's fixed income portfolio, currently valued at $30 million. The portfolio has the following returns over the past 200 days. It's ranked from the highest to the lowest. So you will see that the highest return is 1.9% and the lowest return is negative 1.91%. What will be the value at risk estimate using historical method, right? So historical method, you need to rank the outcomes. 99% probability, right? So it's the 2% significance level. 200 days, sorry, 1% significance level. 200 days means the second worst. Second worst is 1.87 into $30 million. 561,000 is B. Question number 3. John Dumas is in charge of a 100 million equity portfolio. He expects a return of 10% with a standard deviation of 8%. What will be the minimum value of the portfolio at 95% probability? Z score at 95% is 1.65. So which method we use? Once again, we can use analytical value at risk. Return 10%, standard deviation 8%. Portfolio value is 100 million. Let's go 1.65. The value at risk comes to 3.2 million. The question is, what will be the minimum portfolio value at 95% probability? Right, so minimum portfolio value will be when the loss is maximum. which is 100 million portfolio minus $3.2 million, 96 million, 0.8 million, 96.8. Answer is A. Number 4. If the one-day value at risk of a portfolio is $50,000 at 95% probability, this means that we should expect that in one day value at risk of a portfolio is $50,000 at 95% probability. Okay, so at 5% confidence, your value at risk is $50,000, which means 5% of the time it can be more than $50,000, right? So 5% is 1 over 20 days. So one day out of 20 days, the portfolio will decline by $50,000 or more. Answer is B. 95% of the time, your loss will be your maximum loss. Your loss will be less than $50,000. Right? Meaning, 5% of the time it will be more than $50,000. Answer is B. Question number 5. The portfolio manager determines that his portfolio has an portfolio has an expected return of $20,000 and a standard deviation of $45,000. Given 95% confidence level, what is the portfolio value at risk? Again, analytical value at risk. Portfolio has an expected return $20,000. So return is $20,000. That means the percentage return into portfolio size is $20,000. Standard deviation is $45,000, which is standard deviation into portfolio size $45,000. So let's write it again. I will remove brackets and write. This is something we have done in grade 2. Answer is C. Question number 6. Which of the methods for calculating value at risk do asset managers most commonly use? Most commonly used one is Monte Carlo simulation, right? Answer is B. That's value at risk. Any questions, guys? If there are no questions, we can wind up for today. Right? If
So,
I will let you know. Yeah. Yes, Chandi. You have a question? Well, I will let you know about next week's class. Okay, so if that is it, we will wind up for today. Thank you very much. Stay safe. I will see you. I'll let you know when.